How are we doing today, guys? Good. Feel like it will get like the week seven kind of the week seven blahs. You're just kind of like wanting the semester to be a little bit further along, but at the same time, you're just kind of falling behind. And yeah, that's where I'm at right now. I was recalling anytime I feel ennui or just kind of feel like semester is not going quickly enough. I remember this fall of 2020. Truman State made the decision, since we were doing class formatting differently because of the pandemic. Basically, we did all of our classes before Thanksgiving. We did not have any breaks. We did not have fall break. We did not have Labor Day. We met in class on Labor Day. It was basically a 14-week cram course. It was pretty intense and rigorous. So I don't want to go back to those days. So
yeah. Keep the same amount of tennis now.
Yeah, we had to fit everything in before Thanksgiving, because basically the idea was that because of the pandemic, we didn't want people coming back after Thanksgiving, because that's when you get coronavirus spread. So those were the good old days. It was also awful because we were in a classroom that was literally 10 times this size. Had a few more people in it, but everybody had to be socially distanced because of that. So half the people in the class couldn't hear what I'm saying. So I'm at the front talking in my booming voice, and there's like, eh? Yeah, it was kind of awkward. I much prefer this environment. All right, so before we start, you might want to pull up a document I put on Brightspace. It's on week 7. It's called the ICFR testing example. We're going to be walking through that. I'll have an example on board, but I provided a copy for you to refer to if you want to have a copy in front of you. If not, that's okay too. We'll have plenty of time to talk about what's contained within. So today we're I won't say concluding, but we're continuing our discussion of controls. Specifically, we're going to be talking about controls as they relate to internal controls over financial reporting. Now, recall from when we talked about controls in general last week, we had this information that we talked about, that we have 3 general objectives of the COSO framework, which is reliability of financial reporting, effectiveness and efficiency of operations, and compliance with laws and regulations. And here's our good old friend, the COSO cube, which you all remember, and hopefully you've gotten very, very friendly with and just been like, okay, I got to make sure I remember you, especially this front part. But today we're kind of talking about the top part, which is going to be those objectives. And we talked about one of these is more important than the other in a financial statement audit. Which one do we say? Reporting, because reporting relates to financial statement preparation and analysis, and that's ultimately in a financial statement audit what we're focused on. And it is so important that when Sarbanes-Oxley Act was passed in 2002, they specifically talked about this, okay? So Section 404 of the Sarbanes-Oxley Act requires managers of publicly traded companies to issue a report that accepts responsibility for establishing and maintaining adequate internal controls over financial reporting, which a lot of times when you hear auditors talk about this, they call it ICFR. I guess technically it's controls over financial reporting. So there's actually supposed to be an O in the ICOFR, which is why it's called ICFR, but I just like ICFR. And assess whether if ICFR is effective as of the end of the fiscal year. And so this is the details manager's responsibility as outlined in the Sarbanes-Oxley Act of 2002. And we've alluded to this a little bit already. We've alluded to this idea. Remember, we talked about back in chapter 4 with costs, and we said they were not subject to the rules governing testing of internal controls under Sarbanes-Oxley Act. This is basically the rule they're talking about, is that they did not have to issue this report for establishing and maintaining an adequate internal control and make that assessment about internal controls over financial reporting. That's basically because they were subject to certain revenue thresholds, which at the time, again, I believe it was $75 million. And currently, I believe it's $100 million in revenues per year. That being said, this is manager's responsibility. This is what management has to do. What about the auditors? Because we're playing the role of the auditors in this course. Well, Section 404 also requires the auditor to audit management's assessment of the effectiveness of ICFR. So we have to not only audit the internal controls, but we have to assess or evaluate management's assessment saying that internal controls are operating effectively. And PCAOB Auditing Standard 2201 states the auditor must conduct the audits of the financial statements and ICFR in an integrated way, because each audit provides the auditor information relevant to the evaluation of the results of the other. Which leads to an interesting issue, something we have not discussed yet. So we've already talked about the nature of financial statement auditing. We've talked about testing controls. What this implies is that auditors also have to prepare a report assessing the internal controls, the effectiveness of internal controls over financial reporting. And when they do this, they're going to conduct this audit in an integrated manner. In fact, that's what it's called. It's called an integrated audit, where we actually evaluate all of these things jointly. We evaluate the financial statement audit. We evaluate the internal controls over financial reporting together because they are related all in one big happy package related to one another. So to understand that, we need to understand what it is specifically we're trying to evaluate as part of this, a part of internal controls over financial reporting. So let's go ahead and let's go back to our definitions that we talked about at the end of chapter 6 last time. So at a very basic level, anytime there's a problem with internal controls, we call that a control deficiency. And this is just the general term, but this is also the lowest level of categorization. This is basically where we say, there's a control issue, but it's not significant, not material. So control deficiency is a generic terminology, but it's also just kind of our basic guideline. Now, we've already talked about this, discussed this, but let's make sure we're clear on this. There are two types of deficiencies that we as auditors can identify. The first of these is that there's a deficiency in the design of internal controls. Either the controls have not been designed properly or the controls have not been created at all. They're just not present, all right? The second of these is that we have correctly designed controls, but they are not operating effectively, which we call a deficiency in operation or deficiency in operating effectiveness, whichever you want to term that as. Basically, the controls are in place, they're designed properly, but people are ignoring them. And that's kind of the example of when they collude on segregation of duties, or basically Michael Koss said, hey, Sue, can you take over my responsibilities for me? That was kind of the example of the deficiency in operation. So at a basic level, this is what we need to know, but we need to go a little bit further because we have to evaluate controls in the same way that we evaluate audits. We're going to start issuing opinions relative to controls. So what is it that actually affects our opinion? And usually that's going to be the severity of a deficiency. So the next level of severity is something we consider to be a significant deficiency, but not likely to result in a material misstatement, at least not in the current period. That's called a significant deficiency, okay? And remember the example I told you all about that in class? I said I used to have that big blue van and I drove it around without any oil in it. Is it a problem now? No. Will it be a problem in the very near future? Possibly, if I don't put oil in my van. In fact, that's exactly what happened. The van broke down, okay? So that's the example of significant deficiency. And then we have issues that are likely to result in a material misstatement in the financial statements if left unchecked. This is called a material weakness. So when we talk about problems, these are kind of escalating in scope. A control deficiency is a minor problem. This is a major problem. This is a pervasive problem, all right? Now, this is something that's very unique to auditing. If you were to actually go and talk to another instructor and say, what's their opinion on material weakness? You get, well, it's when you buy some curtains but accidentally rip the cloth. That's a material weakness. At least that's what I assume Dr. Eisen would say. You can even like, I don't know, it's something, okay? And then he'd probably mention something about intangible assets. So how are we going to determine whether or not we have a control deficiency? And if so, what type of control deficiency exists? So do you remember back when you were in 303 and you had to identify contingent liabilities and you had to estimate whether they were probable and reasonably estimable? We're going to do something very similar to that with respect to control deficiencies, okay? We're going to assess on two criteria. First, we're going to assess on likelihood. And then if we believe that it's at least reasonably likely to happen or reasonably likely to result in an issue, we need to justify or judge the magnitude of the issue, okay? So very similar dimensions to what we talked about with respect to contingent liabilities. Now let's go ahead and look at this diagram because this is kind of an explanation of how we evaluate this, okay? And this is a really good diagram because it not only alludes to what we're going to be talking about here, but it reflects on some things we're going to talk about later in the chapter as well. So I really like this diagram. So again, our first criteria is going to be likelihood. And the idea being is that we need to evaluate based on controls, what is the likelihood of a control deficiency occurring, okay? Or what's the likelihood of a deficiency occurring? Now, how do you think about this? Well, I would think about this as the idea of a meteor hitting the Earth, okay? Now, if a meteor were to hit the Earth, depending on the size of the meteor, could end up with extinction of all living life on the planet, okay? So we probably should be building a shield around the planet, right? A giant metal shield so that we don't actually, it has to be a shield that can let in sunlight, but a giant metal shield to prevent those meteors. Why are we not doing that? Well, because the last time something like that happened was 65 million years ago, okay? So we're assuming that this is like a once in 65 million year thing. Although if it is once in 65 million years, we're due, okay? Now, yeah, I don't know how what the frequency of occurrence is, okay? I don't have a actuary who actually calculates those things. But again, we're assuming that there's not a big likelihood of a meteor hitting the planet, which means that we don't need to worry about the magnitude of the issue. The likelihood is so remote that we're not concerned about it. Has to be something at least likely or reasonably possible to happen, okay? Now, if we assume that there's a reasonable likelihood of a deficiency, that's when we start determining what is the magnitude of the deficiency. Now, if it's a small deficiency, it's like, okay, if this deficiency left unchecked, it will result in a misstatement of 1 cent, okay? That's where we'd say there's a problem, but it's not a very big problem. So we just categorize this as a control deficiency. We tell it to management, and management would have to correct the problem. Then we say, if it's significant, but not yet material, so it's big enough that it's possible to cause a misstatement, which is a significant misstatement, but only going to be material if it's left unchecked for a long period of time. That's a significant deficiency. Significant deficiency, that's where we report to the audit committee and to management. So we're going to tell management, we're also going to tell the audit committee that there's a significant deficiency that they should be aware of. And then material, that's basically saying that if a control deficiency left unchecked, it's likely to result in material misstatement. That's a material weakness as we specified. We report to audit committee and management, but then we also report that externally. And we're going to get into a lot more detail about what that entails here in just a little bit. So you can kind of see the escalating scale of what this represents. So to assist management, the SEC issued guidance for evaluating and assessing ICOFR. And this actually has 3 steps. Identify financial reporting risks and related controls. Consider which locations to include in the evaluation. And then finally, evaluate evidence about the operating effectiveness of ICOFR, okay? So we're going to consider this. Again, this is SEC issuance to management about their assessment, but we are responsible for making sure that management's assessments are reasonable. And we're going to issue our own opinion about what we think the status of ICOFR is. So let's talk about the audit steps in performing an audit of ICOFR. By the way, I apologize for my stumbling today. For some reason, I am really having trouble speaking, but I am stuttering a lot today, which I never do. I usually just repeat myself intentionally. All right. So while the audit of ICOFR and audit of financial statements have different objectives, we need to actually perform both as an integrated audit. So one thing you're going to notice about this chart here, this diagram, is this looks very much like how we would plan and perform an audit. And that's intentional because it's going to occur simultaneously alongside an audit. Now, one thing I want to warn you about for this particular section, I always 100% of the time ask questions on the next, what would that be? The next, I want to say 5 slides, maybe it's a little bit longer. Yeah, so the next series of slides, maybe it's probably like the next 8 slides. So ones that have these boxes right here, we're going to see a lot of them here. I ask a lot of questions about those. My students are always very underprepared for those. So as we're going through these, keep in mind there's a 100% chance that I will ask questions about this information. So it's probably information that you need to be aware of. So I will kind of point those out and say this is what you should be aware of when you're going through this. So we're going to go through each of these steps and talk a little bit about what they entail. So the first item is going to be, how do we plan the audit? Okay, so we're actually talking about the planning of the audit ICOFR right up here, all right? So it involves the following activities, all right? The role of risk assessment and the risk of fraud, because remember, we talked about risk assessment and evaluating what we believe the risks are, and fraud is just basically one of those certain categories of risks, because we've identified risk of intentional manipulation, which is fraud, as we talked about. So as part of risk assessment, why is this included in this analysis? Well, controls are effectively responses to risk. So in order to understand the nature of controls, we have to understand the nature of the risks present in an organization. Also, scaling audit. Certain risks are going to be more prominent than others, so we need to understand what areas do we need to focus on as auditors and what resources are required with respect to that. And then finally, using the work of others. Presumably, we're talking about the internal audit function, but this can go well beyond that if necessary. We want to get any level of assurance that can, or any level of detail that can provide us assurance with respect to our analysis here. So if we can rely on the internal audit function or other resources that the organization has in place, we can use that to gain assurance about the controls that are in place. All right, next, we're going to identify controls to test, okay? So this is going to be a multi-tiered assessment. At the highest level, we're going to be talking about entity level controls. Why entity level controls? Well, one of the most important things we note is that we've got 5 components of the COSO framework, and one of those stands at the very top. Which one was that? Control environment. Remember, I said that I felt that was the most important aspect of in the COSO framework, the most important component. Why? Because if the control environment is bad, it doesn't really matter about the rest of controls. If you've got somebody at the top who's not taking control seriously, nobody in the organization will. So entity level controls are going to kind of entail that control environment. In fact, I'd say our primary entity level control that we're going to be discussing or evaluating here is the control environment in place of the organization. So that's something you should note. If I ask you, what is an entity level control? You should be able to say control environment, Dr. Barnes, okay? Because that's our primary control from at an entity level. What are some other examples of entity level controls we should be aware of? Well, one should be one that we're very, very well acclimated with. That's the period end financial reporting process. So in the creation of financial statements and the creation of that financial reporting, what is the goal? Remember, that's so the organization, the managers reports to the stakeholders about the position of the organization. Why do they do that? We're trying to make sure that they're doing their job properly. Is it effective? One big articulated control, but it's a very large control because it represents the organization as a whole. What else have we got? Okay, you've probably heard of a code of conduct that's in place in an organization, outlines everybody's ethical responsibilities that are in place. And then we've also got some very relatively new ones. I say relatively because it's become more common in the past 2 decades. Excuse me, past 2 decades, that's going to be whistleblower hotlines and the like. So we can actually have external reporting mechanisms about the organization. So all of those represent very, very dynamic and powerful entity level controls, which are things that we should be familiar with in this area. Then we get down to a little bit more of the details that we've discussed already. Identify significant accounts and disclosures and their relevant assertions. So when we identify an account, we should be able to identify risks associated with that account. What do we know about the characterization of risks at the control level? They're characterized by assertions. That's how we determine what the risks are. We say, what is the management assertion that's in place here? Once we've done that, we need to understand what are the likely sources of misstatement? What are the areas that can create problems in the financial statements or with financial reporting? And then we're going to select the controls to test based on that. This goes back into alignment with that idea of the control sequence. Remember, the control sequence tells us that we start with identification of risk and the management assertion. Then we identify what the controls are that the client has put in place. And this is where we determine how do we test those controls. Now, as far as specific test of controls go, we're going to get into more detail on that once we get to the business process chapters. But for right now, it's important to note that at a basic level, our goal is to make sure that we understand how all of these objectives align with one another. If we identify that existence occurrences are going to be a major assertion in an area, we need to determine what has management done to address the risks associated with the existence occurrence in an account, and what do we need to do to determine whether the controls are working effectively or not. All right, moving on. So we're now going to evaluate the design and test of operating effectiveness of controls. What are the dimensions? Well, these dimensions are ones that we've already seen before. We're going to talk about nature, extent, and timing of procedures that we actually need to perform here. So nature, what types of audit procedures? These are going to be very closely in alignment with the procedures that we spoke of with respect to test of controls. Remember, inspection of records and documents, observation, inquiry, reperformance, and walkthroughs. Oftentimes, these are going to be tailored according to what controls we're testing and the scope of the controls. Our walkthroughs can be very, very powerful in this area because these allow us to do a lot of testing over just a single transaction. We'll gain a lot of assurance over a single transaction. But they basically do involve all of the other types of tests. So they can be they can be very involved. Also, extent, we want to know how many tests we need to perform, and if we're looking at controls and we're having to test a batch of information, what are our sample sizes going to be? Now, the good news is, which I probably should mention this, we're going to be talking specifically about sampling on Wednesday next door, okay? We're going to be over in 1420 because I want to actually try to get some people to give access to IDEA. But we're going to be meeting over there on Wednesday, and we're going to look at what are some methods that audit firms use for selecting samples with respect to controls testing and also substantive procedures. Also timing, we need to determine whether or not we can perform certain tests during interim and year end. Okay, so let's go ahead and let's evaluate kind of what we've talked about up to this point by looking at the example that I had you guys pull up in Brightspace. So this is going to be this I call for identifying or evaluating identified control deficiency. So this is actually the slide here, but this slide is just this document that I put on Brightspace. So we have Bill Boyd, who's the manager for Emmons and Shin, and he's doing procedures in place over the entire period to account for cash received in the bank lockbox. Now, we see this term bank lockbox and we say, okay, I know what a lockbox is, Dr. Barnes. I see it at the sporting events. Delta Sigma Pi carries around a big metal box and they put the cash in there. That's the bank lockbox, right? No, that's not a bank lockbox, okay? It is a lockbox, but that's not what we're referring to here. We say bank lockbox, that's actually a system of cash receipts that a bank organizes for an organization where their customers send cash directly to the bank and the bank prepares their reports to issue to the client. So why is that so important? Well, remember we talked about a risk that we had where maybe cash receipts would get apprehended by somebody who receives the cash. Whoever has custody could actually put the cash in their pocket and never report it. How do we bypass that? We can say, well, send it directly to the bank. It will never go into anybody's custody except for the bank. So this is kind of the bank lockbox system. Now that provides a lot of new opportunities. It's a neat little control. However, there are some concerns in this area. So how does this work? The entity receives a list from the bank, the electronic file listing cash receipts from the customers. They apply the cash received in the lockbox to individual customer accounts. Any cash received in the lockbox that is not applied to the customer account is listed on an exception report called unapplied cash exception report. So basically we get this report from the bank and we can look at this report and say, all right, this receipt matches this invoice, this receipt matches this invoice, so on and so forth. What happens if a customer sends a cash payment, they send their payment in that we can't match to invoices? That's where we get this exception report here. That's where we say, all right, we don't know what this is supposed to be applied to. Let's create this exception report. Now, this list is some very interesting things here. This actually refers back to something we talked about in AIS. The application of cash to the account is a programmed application control. So this is what the system does. It tries its best to identify cash receipts and apply them to customer payments, okay, or to customer invoices. But in the event that we actually have exceptions, that exception report is considered to be a manual control, where we look at the report and say, all right, here are all the unapplied cash payments or cash receipts. What do we do with those moving forward? Bill is going to say, I want to actually test and make sure the manual control is working. And I want to make sure that the misstatements in cash and accounts receivable would be prevented or detected on a timely basis. So he's going to test the manual control. So how do we go about this? Well, very first thing is we need to determine whether there's a list of non-matching cash items on the exception report. So he's going to perform test of controls to assure the operating effectiveness of the control for review and follow up to the daily unapplied cash exception report. Now, how does this work? Well, we've got this exception report. Somebody in management should get this report and say, I'm going to determine why this cash receipt cannot be applied to an invoice. Is there just not an invoice present, or did they pay an invoice for a different amount than the invoice said? So somebody in management is performing this control manually. They're looking at the amounts and they're trying to apply them and trying to get an explanation for why the cash receipts don't match. So once they perform this task, they get explanations for them. They document the explanations and that report is going to be resolved. Bill said, all right, I want to determine how this process works. I'm going to inquire of somebody. You're going to explain to me this whole process. And they explain just what I explained to you. And Bill's pretty happy. It's like, okay, all right, now I understand this exception report process and what the process that follows is going to be. So we've got some evidence and we're good to go from here, right? So we can call it good. We can move on with our slides. What is the problem with just calling it good here? What type of evidence is it that Bill just acquired? I'll give you a hint. The first letter or first word kind of gives you an implication of what the evidence is. Inquiry. It says inquired. Inquiry. What do we know about the reliability of inquiry?
It's very low.
It's very low, okay? Because management could lie to him and tell him something completely false. So does it make sense that Bill probably needs to move forward? That's why there's a second page to this guide, by the way, okay? Yeah. So he discussed the matters, but he's actually going to perform some more stuff. He actually learns a little bit about the process and gives a little more detail. And he says, now that I know enough about this process, I can re-perform this control. So he selected a sample of 25 daily unapplied cash exceptions reports. And so he said, all right, I've got the exception reports. Here's what I would do if I was performing this control. And then he compared that to what was actually done. If there were any differences, that's an exception. If there are not any differences, then there's no issues. Everything is effective. And it turns out that he actually did the test and he said, all right, I actually managed to match everything that they did to what I did. Everything looks good. I'm very happy with the way this control works. I'm going to say this control is effective at this point in time. All right. But you will notice if you look down the screen, there's a little bit more down here. There's a little bit more down here. So what's going on? Okay. Let's go ahead and go back. So you'll notice that, what does it say here? Somewhere in here, maybe I'm missing it. He's performing interim testing, I guess is what I was trying to say, is that, yeah, I know that's in here in the report somewhere, and I should have had it best up, but sorry. Oh yeah, they performed an interim date, but I know that's earlier in the report. So we talked about controls and say if they're performed at interim date, we actually have to follow up at the year end to make sure they are still operating effectively, because presumably control will not change, but we can't take that as fact. So Bill basically says, all right, I'm going to do some little bit more inquiry year end to make sure the procedures are still the same. And I'm actually going to do some observations. I'm going to scan the unapplied cash report and see that it's still operating the same way. So what is this test right here? This is basically just a follow-up test at year end to say, what I did before, is it still consistent at year end? If the answer is yes, he's pretty happy that controls have operated the same way throughout the year. So that's basically what that third step is talking about. And we'll allude to that third step here in just a second. All right, moving forward. So now we're going to evaluate control deficiencies. As discussed earlier, the severity of a control deficiency depends on two factors. All right. The possibility of controls will fail to prevent or detect and correct a likelihood or misstatement. So likelihood. So a control there's a chance that a control can fail. And if that's the case, then it will prevent a misstatement. It won't prevent a misstatement. Or if the control is a detective, it will fail to detect and then subsequently correct the misstatement. That's our likelihood concern. If we assume that it's at least reasonably likely that the control will fail, that's where we move on to magnitude, the amount from a potential misstatement resulting from a control deficiency. All right. So these are two criteria. We have to evaluate both of those in given scenarios. So the good news is for you guys, I actually have a couple of scenarios. So let's go ahead and work through these. All right. Murray Company processes a significant number of routine intercompany transactions on a monthly basis. Individual intercompany transactions are not material and primarily relate to balance sheet activity. For example, cash transfers between business units to finance normal operations. A formal management policy requires monthly reconciliation of intercompany accounts and confirmation of balances between business units. However, there is no process in place to assure performance of these procedures. As a result, detailed reconciliation of intercompany accounts are not performed on a timely basis. Management does perform monthly procedures to investigate and select large dollar intercompany account differences. In addition, management prepares a detailed monthly variance analysis of operating expenses to assess their reasonableness. Now, I don't particularly like the way the scenario is set up in the book because it actually only gives you two options. It says it's going to be a significant deficiency or a material weakness. But let's go ahead and let's operate from the assumption that we need to assess both likelihood and magnitude, okay? Based on the information given, is it at least reasonably likely that a material mistake or that a deficiency would occur in this situation? Presumably so, okay? Presumably so, because they basically say that they've got a weakness in place, and they're not a review. There's not a reconciliation there. Okay, so at least reasonably likely. The question then is that we need to determine what is the type of deficiency. So remember, there are three categories. There's control deficiency, significant deficiency, and material weakness. Control deficiency is small, not likely to be a big misstatement. Significant deficiency is significant but not material. Material weakness is likely to result in material misstatement. Based on the information given in this particular scenario, what do you guys think? Do you think this is bigger than a control deficiency? Yes, because it says significant deficiency or material weakness. Okay, that was the big clue. All right. Is it going to be big enough to be a material weakness? What do you think? So one big clue is that individual intercompany transactions are not material. That's one of the things that says in the first paragraph. So it's unlikely that if this control fails, it's unlikely to result in a material misstatement. Additionally, one of the things they talked about before is they've got redundant controls in this area. Even if the control fails, it appears that management does perform monthly procedures to investigate those differences, okay? They also do a monthly variance analysis to assess reasonableness. So if there is a failure, there are redundant procedures, so it's unlikely that there will be a material misstatement. Therefore, this is probably going to be a significant deficiency. Good, okay? Let's look at a second scenario. Regarding a company possesses a significant number of intercompany transactions, processes a significant number of company transactions on a monthly basis. Intercompany transactions relate to a wide range of activities, including transfer of inventory with intercompany profit between business units, allocation of research and development cost to business units, and corporate charges. Individual intercompany transactions are frequently material. A formal management policy requires monthly reconciliation of intercompany accounts and confirmation balances between those business units. However, there is no process in place to ensure the procedures are performed on a consistent basis. As a result, reconciliation of intercompany accounts are not performed on a timely basis, and difference in intercompany accounts are frequent and significant. Management does not perform any alternative controls to investigate significant intercompany account differences. All right. So our likelihood threshold here? Yes, okay, certainly, because it says that there are frequent and significant, okay? Now, that word significant is misleading because we need to determine what's the magnitude of this particular scenario. All right, we know it's going to be at least a significant deficiency because it actually uses the word significant. But is this likely to result in a material weakness if left unchecked? What do you guys think? Yes, because it says individual intercompany transactions are frequently material. So the lack of controls in this area is likely to result in a material weakness, a material misstatement. So we're going to call this a material weakness. Okay. So that's kind of how we evaluate it. Just for you, so you know, one of your homework assignments in this area actually talks about this and actually does some has you do some testing in this area. Again, it operates on the assumption it's either significant deficiency or material weakness. For the exam, you will need to evaluate all possibilities. You'll need to evaluate control deficiency, significant deficiency, material weakness, or the possibility that no control deficiency exists whatsoever. Okay. Yes.
Can you evaluate like multiple redundant controls, taking into account like if the prior controls are like material weaknesses or not?
Yeah, you would evaluate the other controls as well in unison with those. Like say if you had controls that were supposed to be redundant that weren't working, then that would actually affect whether or not it would be a material weakness in a given control as well. But even so, even if like say the redundant controls are likely to prevent a misstatement in this control, we would still evaluate it as a control deficiency because that would still be a control that's not working properly. It's just not likely to result in a material misstatement thanks to other controls that are in place. All right. So remediation, we've talked about this all before, is the process of correcting a material weakness in internal controls or financial reporting. So the idea being is that we as auditors do our testing. We identify a material weakness and we go to the client and say, you have a control failure here that is significant enough to result in a material misstatement. The client has an opportunity before year end to actually fix this problem. In order to remediate a material weakness, two criteria have to be met. All right. The first criteria, if it's corrected before the as of date, which would basically be the balance sheet date, okay, or sorry, not the balance sheet. The as of date would be the issuance of the financial statements, excuse me. There must be sufficient time for both management and the auditor to test the operating effectiveness of the control. So management has to assess the control. They have to retest the control and assess it. Also, the auditor has to have time to test the control and assess it. Both of these criteria have to be met in order for this to work. It can't just be management assess it and then auditor says, we'll take your word for it. There has to be sufficient testing for both. If either of these criteria fails, if one of these two does not happen, then an adverse opinion will be issued, which is kind of a spoiler for what we're going to talk about with respect to opinions. So material weakness is going to result in an adverse opinion. This is trying to prevent that adverse opinion from happening, but it does need to be corrected. Now, does this mean that there's no chance of a material misstatement in the financials? No. Keep in mind that this is separate from our assessment of what the financial statements say. We still have a responsibility for auditing the financial statements and the reasonableness of the numbers there, okay? A prior existing material weakness could still result in a material misstatement from earlier when the controls were not working properly. So we would have to assess that separately. All we're saying here is that in our report of internal controls over financial reporting, as of a certain date, the control was working properly, okay? I think I said as of again, and so as of date, okay. So after auditing the effectiveness of the entity's internal controls, an auditor issues an unqualified opinion if the entity's internal controls is designed and operating effectively in all material specs. So basically, we're going to test controls. We're going to evaluate controls. If all the controls are effective, which would be the dream scenario, by the way, that would be the perfect one. It's never happened in all the time that it didn't happen in all the time I tested controls and auditing. But if the controls were all effective and working properly, we'd say we can issue an unqualified opinion, which is fantastic. That's basically where we'd want to be. That being said, what happens if there are control deficiencies? The most likely scenario. Well, let's go ahead and look at our diagram. So let's focus on this side first, okay? We have two possible scenarios. We have a control deficiency or a significant deficiency. If control or significant deficiencies are the most extreme of any deficiencies we identify, we're still going to issue an unqualified opinion. Now, for control deficiencies is obvious because a control deficiency, we've basically said that that's a small issue, okay? It's something that gets reported to management, but it's not likely to result in any kind of misstatement of any significance. But significant deficiency is certainly problematic. We'd say, well, Dr. Barnes, that's significant. And the answer I come back with is currently it's a significant problem, but it's not a material problem. Now, what happens if we had significant deficiencies in the same control over the past 3 years? That could change the scenario, because remember, I said a significant deficiency, if left unchecked, is likely to become a problem in the future. So if I have a significant deficiency, it was brand new in the current year, I would still issue an unqualified opinion. If I had a significant deficiency that was left unchecked for 3 years, that's what I would start saying. You're not taking this seriously. You have not corrected this problem that has been a significant deficiency for many years previous. That's when I'd probably start thinking about it being material weak or an issue. Okay. I'd probably upgrade it to a material weakness, which, as you will notice, a material weakness is likely to result in an adverse opinion. Why is that the case? Think about our criteria for an adverse opinion for the financial statements. We said that financial statements are materially misstated. That's likely to result in adverse opinion. The financial statements are not free from material misstatement. A material weakness is just the control variant of that. It's a control weakness that is likely to result in a material misstatement. So if we say material weakness, we assign an adverse opinion. You will notice here that there is no such thing as a qualified opinion for ICOFR, okay? I do think that may change in the very near future, okay? But currently, as we're going to treat it in this course, there's either an unqualified opinion or an adverse opinion. There's one other possibility, because we have not escaped the possibility of opinions. There's actually the issue that we could not perform ICOFR testing properly. Remember that idea of a scope limitation that we talked about back with financial statement audits? The same could happen with respect to controls testing. We tried to test a control, but we were unable to do so due to certain client constraints. If we're trying to issue an opinion, we can issue a scope limitation, and if it's large enough, it could result in a disclaimer of opinion. Okay, so that's a very, very rare scenario, because if we're supposed to test controls, if we're required to test controls, it's very unlikely the client's going to prevent us from doing so, but it can happen. So just to recap, control deficiency, significant deficiency, or no issues whatsoever, unqualified opinion. Material weakness, adverse opinion. A massive scope limitation or pervasive scope limitation still is going to be a disclaimer opinion. There is no such thing as a qualified opinion for ICOFR. Now, keep in mind, this is separate. This is a different opinion than the one that we issue for financial statements, okay? We're performing a separate audit, specifically an audit over internal controls over financial reporting. So this would be a different report, a different opinion than the one of the financial statement audit. So does that mean that I could have control opinion of one type and an audit or financial statement audit opinion of another type? Yeah, I could say, yeah, the controls there, I've got an adverse opinion on controls, okay? The controls themselves are a mess. I don't really like the way they work. They're likely to result in a material misstatement, but I could have an unqualified opinion for my financial statement audit. Why? I could have said, well, I believe that there are material misstatements in the financial statements, but management was willing to perform adjusting entries for those misstatements. And now I believe the financial statements are fairly stated. So even though the controls are bad, the numbers are correct, or at least materially correct. The reverse is also true. You could also say that the controls are good, but the numbers are still correct. Maybe management overrode controls and they misstated some numbers that they shouldn't have, and so we don't like what they did in their mistake and their adjusting entries. So the possibility exists. These are basically two separate items. Ultimately, we'd love them both to be unqualified. That's the dream right there, but they're two separate opinions.
So wait, so if you override a control, isn't that still a division?
If it's a management override of control, that would probably be an action, and specifically that we talk about it, we're talking about a transaction issue, as opposed like the control failure, because remember, management override is a limitation of controls, so the control itself cannot be prevented that. So you could make an argument that management override of controls is a failure of controls if a override exists, but more likely you would say that this is a management action that's to bypass control, which would be more of a reporting issue. All right. So what are some other reporting issues? Well, we also need to consider subsequent events. So we're going to talk more about subsequent events in general in chapter 17. But with respect to internal controls, we are responsible for assessing controls up until the report date, the financial statement report date. Auditor report is auditor is responsible for that. If there are any significant changes in control before the issuance of the financial statements, we have a responsibility to report on that as auditors. Also, we're going to talk about in chapter 18 what happens when an auditor has to rely on the report of other auditors. So this may happen if a situation comes up where somebody else performs testing of controls, and it frequently does happen, particularly with SOC reporting. We needed to make a determination of how do we actually treat reporting from other auditors. Generally speaking, it really relies on whether or not we're willing to take responsibility for their work or not. But again, we'll get to that more in detail in chapter 18. All right. What happens if management's report, because remember, management has to issue a report under Sarbanes-Oxley 404. What if they issue a report, but it's incomplete or improperly presented? Okay. Well, that is where the auditor is going to take their own reports, their audit report over internal controls over financial reporting. So remember that report where they issued the opinion? We're going to make a modification to that report and say, management's report is incomplete or inaccurate in such a manner. Here's the information detailing what management has done incorrectly. So if management is not properly presenting their information, we have a responsibility as auditors to disclose that in our reports. What about if management report is complete, but then they throw up a whole bunch of information that's not relevant or not necessary, okay? Keep in mind that we as auditors have only only audited management's assessment and the controls therein, okay? We have not audited any of that additional information. So in our report, we would say, we have audited this information, we've audited the controls and management's assessment of controls. We issue an unqualified opinion or whatever the opinion may be. As far as this other information goes, this additional information they've included in their report, we have no opinion on this. We disclaim an opinion on this information because we have not audited that information. What about reporting on a remediated material weakness at an interim date? So remember, we talked about the possibility that we identify a material weakness, we try to remediate that material weakness, but time just lapses. There's not enough time to test the control for both management and auditor. What if during the quarter after the issuance of the financial statements, management fixes the control and the auditor actually is able to test the control and they say, looks like the control has been fixed. Are they just going to be left with a material weakness for the rest of the year and then basically come up next year and says, okay, we'll test the control again now? The answer is no. There is an opportunity that if management can remediate the material weakness at an interim date, we can issue an interim report stating that this control has been remediated and now the opinion is unqualified. Okay, it's a possibility. That does not change the previous opinion. That just issues a new opinion subsequent to the original opinion. Yes.
So when you issue an adverse opinion at the beginning, do you say that management is taking this into consideration and working on testing that control?
Generally, it's pretty boilerplate language, so we would not talk about management's efforts to address the issue, but management could disclose that in the financial statements if they are forced to issue a material weak or a adverse opinion on a material weakness. Yeah. All right. So as far as communication goes, the auditor must communicate in writing to management and the audit committee all significant deficiencies and material weaknesses identified during the audit. Okay, this is according to Audit Standard 2201, and the communication should be made prior to the issuance of the audit reports on ICOPR. Okay, so basically, remember what we talked about before. We said that all control deficiencies, regardless of scale, whatever level, all of these get reported to management. So if it's just a basic control deficiency, it gets reported to management. If it's a significant deficiency, it's reported to management, and then also the audit committee knows about all significant deficiencies. If it's a material weakness, that's when the doors blow off. That's when everybody gets to know about it. Management, audit committee, and then we report it externally as well, okay? In addition, the auditor should communicate to management in writing all control deficiencies identified during the audit and inform the audit committee when such communication has been made. So this one's a little bit confusing, so I want to clarify what this particular point means. Now, the audit committee will not know what the control deficiencies are. We're not responsible for communicating that. And it's probably a good idea because if there's a lot of control deficiencies, they're so minor in scope that the audit committee probably doesn't care about those. But we are responsible for telling the audit committee that we have communicated this information to management, and we need to tell the audit committee on the date that we reported that information. So they do know that that information has been communicated and conveyed to management, and they know when that happens. All right, just to recap. Control deficiency gets reported to who? Management, okay? Significant deficiencies get reported to management and who else? Audit committee, okay? And then material weaknesses get reported to management, the audit committee, and who else? Everybody externally. Everybody gets to know about it. It's issued, it's a part of their audit report and the adverse opinion. And that does it for ICOFR testing. All right, we got sampling in 1420 on Wednesday. I'll see you all then.